which is what I call the perfect storm. And this perfect storm, the transition is very orderly. And I'll show we have undergone in the mortgage lending and the housing market about 8 different government imposed regulatory changes since 2008. You know, that is significant because in the previous 50 to 75 years, we didn't have 8 in total. So the change has been very significant. So you've got all these regulatory changes. You've got product changes, policy changes, interest rate changes. You've got, and you have been operating in a market like we have never seen before in the last 2 years. So you take all of that, and then you add to it the most significant, profound impact of anything, and that's Donald Trump. Since he's been elected for 200 odd days, he has not, well, I guess you could say, he has only got 3 of his agenda items through Congress. One is still in the works, and that's tax reform. He finally got his immigration ban through Congress. He finally, I guess just a couple days ago, one of the items on his list was recognizing Jerusalem as the capital. And you see what happened there, the turbulence that's going on, and that's not going away anytime soon. Everything he's done has caused real problems south of the border, but around the world. And right now in Canada, we're undergoing the free trade agreement negotiations. It was supposed to be done by the end of December. It's not going to happen. The extension is now to the end of March, which is probably not going to happen. In fact, I don't even think the free trade agreement is going to go through. And that may have some impact on our economy. Then you've got Trudeau in China this week. I wasn't successful in negotiating anything with them. So there's so much going on that could affect our economy in Canada. And as a result, we've got the Bank of Canada right now basically on hold when it comes to interest rates. And I'll talk about that in a few minutes as well. One of the most positive things that's come from Donald Trump's time in office has to do with international students. And typically in the United States, students from South America would go to the United States for their post-secondary education. As a result of the travel ban, those students are coming to Canada right now in huge numbers. And then you've got stuff going on over across the ocean, Brexit, and you've got Frexit. And students from China, India, Philippines, Africa would normally go to the UK for their post-secondary education. They're coming to Canada this year in big numbers. Now, the university enterprise in Canada right now is worth about $35 billion a year to our economy. That's a lot. That is very significant. As a result of the international student migration to Canada this year, it is generating an additional $11 billion in our economy. That's a 33% growth. Now, there are 98 universities in Canada right now. Half of those universities are in Ontario. Half of those are in GTA. So when these students finish their 4 or their 6 or their 8 years of education, the likelihood of them returning to their home country is minimal. They're going to stay here. And they're going to be what we call immediate economic contributors to the economy of Canada. And that is very, very positive for housing in GTA. Because these students that are coming from other countries to Canada right now, they're coming here with a lot of money. The average tuition cost for an international student in Canada is about $45,000. The domestic student pays $25,000 tuition. So these folks are coming here with money. They're already, we're seeing they're buying condos, they're buying luxury cars. This is very good for our economy, and this will be very, very good for housing in GTA. So with that, I guess we could thank Mr. Trump for that one, because that's very, very positive for GTA. So let's take a look at the market. And here I have GTA housing for 2016. So we had last year we had 113,000 MLS sales in GTA. That's 11% higher than the previous year. By the way, 2016 is the best year ever in housing in GTA. 2015 is the second best year ever. Now, of the 113,000 MLS sales, 51% were first-time homebuyers. 51%. Of the sales in 2015, 53% were first-time buyers. Next year, with the regulatory changes, I figure it's going to be about 48, 49% first-time homebuyers. Notwithstanding the decline, a little decline, first-time homebuyers represent a huge portion of sales in GTA. They are what is driving the market and will continue to drive the market. Average price in GTA last year, $729. It was up 20% over 2015. The reason we saw price increases is the supply and demand. We had low inventory in GTA for the last 2 years, high demand. So when you get a low inventory, high demand situation, you will always have price escalation. Now that's changing now, but for the past 2 years, we've seen significant price growth here in GTA. And then you have new construction. Last year we did just shy of 42,000 units. That was a decline over 2015 of about 8%. Now the reason we saw new construction decline, there's 2 reasons. One, lack of available land in GTA for new construction. And number 2, most of the condo developers in the GTA were trying to sell off their inventory before they broke new ground. And we're seeing a real uptick in new construction right now. In fact, the numbers were just released this morning, about an hour ago. What's also interesting here in the new construction is that the majority of new construction now is in multi-unit. Whereas in March of this, and by the way, of the new construction, about 80% is multi-unit. In March of this year, multi-unit was 30%. So there's a huge movement towards new construction, multi-unit development. And then you have the real success story in GTA, new immigrants. And this is not the final number, I don't have it yet, but it looks like it's going to be 80,000 new immigrants to GTA last year. And this year will probably be about 84. Next year will be 88. The year after will be 90, and then 100, and so on. This is really what is driving housing in GTA. Why? Because the new immigrants that are coming to GTA right now, they're young, they're educated, and they have money. Versus the new immigrants from 2011 census, those new immigrants were coming from the UK. They were older, and they didn't have money. These are very different. And this is very, very positive to housing because they are immediate economic contributors, and they support housing. Of the 50% of the sales that were first-time home buyers, 50% of that was new immigrants. And they are what's going to continue to drive and support housing. And new immigrants, like the source countries right now are China, India, and Philippines. And they have wealth, a lot of wealth. So this is very, very positive. And when you think about what drives housing in any market, in any city, in any country, there's a few things. Number 1, employment. Number 2, income growth. And number 3, population growth. Now in GTA, our unemployment rate right now is just shy of 7%. We had growth in employment last year of 2.5%, very strong. I would say next year we'll probably have 1.5% growth. And then you've got income growth, GTA, 2.5% income growth. And then you've got population growth driven by these folks. It doesn't get better than that. And those three fundamentals are what is driving housing in GTA. And when you have those fundamentals, you will not ever have a crash. I don't care what the media says, you cannot have a crash in housing with those fundamentals. And we won't. Yes, we're going through a transition right now, but we are not going to have a crash. It won't happen. So, strong fundamentals in GTA. Last 2 years, best 2 years ever. I talked about home price growth, factor of low inventory. And by the way, you know, the provincial government came out with the Ontario Fair Housing Plan earlier this year. There wasn't one thing in that Fair Housing Plan that dealt with the low inventory problem in the GTA. Not one. In fact, what the plan did was go after demand. We don't have a demand problem in GTA. We have an inventory problem in GTA. And they missed the mark totally. Right now, the dollar, this morning we're at 77.5. The dollar between 78 and 82 is a nice place for us to be because it drives manufacturing and our exporters. And when our manufacturers are generating and selling their goods, it creates employment. Employment drives housing. So the dollar at the 78 to 82 cents, this is very positive for us. And I suspect that that's where it's going to continue to stay. And then you've got tourism. Now in the GTA last year, we had 9 million tourists come to GTA. That's 3 million more than the entire population of this whole region. 9 million tourists, and they spent $7 billion in our economy. And they supported the hospitality sector, which drives jobs. Jobs drives housing. So this is very positive. Now I see 4 waves to this perfect storm that we're in right now. Wave number 1 came in November of last year, when the Department of Finance implemented changes as it relates to mortgage loan insurance. Now there are 3 types of mortgage loan insurance providers in Canada. There's CMHC, there's Genworth, and there's Canada Guarantee. And there's 3 types of mortgage loan insurance. The first one is high ratio. As you know, any home purchaser that cannot come up with 20% or more, they are called high ratio transactions, and they have to take high ratio mortgage loan insurance, and they pay for that. The second is low ratio transactional, and this could be where a bank doesn't particularly like the borrower or the property for that transaction, and they say for that deal we want low ratio insurance. Even if the customer comes up with 50% down payment, the bank would say, we want that deal insured. Now, this doesn't happen in GTA very often. Very, very rare, actually. Where you see this is in rural communities or small one-industry towns where there's the potential that the industry might close, shut down, and as a result, mortgages go into default. So the banks want those transactions insured. And then you've got the third type, which is portfolio insurance. So this is where banks or monoline lenders like MCAP, Street Capital, Home Trust, and so on, we will take our mortgage book of business. So this would be all of the loans from 0 to 80% loan to value. We'll take that whole portfolio and we will insure it against loss. So the bank will pay for this portfolio insurance. So last year at CIBC, we did about $7 billion in portfolio insurance.
Who would insure that?
Who insures that? The government.
UCMHC?
CMHC, yeah. So basically what happens, so in CIBC's case last year, we did $7 billion of our mortgage book of business, so that was about 30% of it. We didn't portfolio insure it. That means then that the bank is now 100% government guaranteed. So there would be no loss. And that's why the banks can, their margins on interest rates can be very, very low because there's no risk to the bank. So what happened November of last year, the government came along and said for any high ratio transactions, so anything over 80% loan to value, the borrower has to qualify at 4.64%. Now that rate today is up, it's at 4.99, and it's set every week by the Department of Finance. So everybody has to qualify at 4.64%. The maximum amortization is 25 years, and there will be no properties insured over $1 million. Now, this is problematic in GTA because in March of this year, 33% of the sales this year were over $1 million. Right now, it's about 60% over $1 million. So there's the new rules as of November last year. Then in the spring, the government comes along and says, by the way, any financial institution who wants to portfolio insure, anybody in that portfolio has to qualify to these guidelines. Now, if the banks go along with that, it'll shut the housing market down completely. Basically, the banks have said, we're not going to go along with this. We don't need to portfolio insure, because typically portfolio insurance does two things. One, it protects a financial institution against potential loss risk. And the second thing is that, so the banks or the monoline lenders take their portfolio insurance, they insure it, then they securitize it, then they sell it off, they get the money back, and then they lend it out in mortgages. Now the banks don't need to do that because we have enough capital. Like we gather deposits that we can lend out in mortgages. So we don't need portfolio insurance to do that. But the small lenders do, like the home trusts and the street capitals and the MCAPs, because they don't have a means to gather deposits. So they have to portfolio insure, and when they do that, they have to qualify to these rules. That is going to essentially cause a pretty significant crisis to the mortgage broker market share. In fact, mortgage broker market share last year was 35%. It's down to 20% because of that issue. Very significant. What you're going to see in the monoline lender community is you're going to see consolidations and closures because they can't compete with the banks. It makes sense. So that's wave number one, November of last year. Wave number two came in April of this year, April 20, when the Department of, or the Ontario government implemented the Ontario Fair Housing Plan. Now there were 16 initiatives in the Ontario Fair Housing Plan. Not one dealt with the low inventory. In fact, there isn't one thing in the Ontario Fair Housing Plan that helped housing in GTA right now. Not one. So it was not the Fair Housing Plan that's wave number two. Wave number two is actually the media. And if you think back to January, February, March, April of this year, every time you pick up a paper or turn on the radio or TV, all you heard was GTA housing crisis, bubbles, crashes, doom and gloom. That's all we heard. What that caused is people to say, wait a minute, I want to step out of this market and see what happens. And that's exactly what happened. People just stepped out of the market because of the negativity of the media. Now, the impact of the media on the GTA housing market This year, 5%. The impact of this on the housing market in GTA is about 3%. Now, when it comes to the media, that's only temporary, because as soon as the media focuses on Donald Trump and less on GTA housing, people are going to get back into the market. We're already seeing that right now. So, media, wave number 2, 5%. Wave number 3 came in July and September, when the Bank of Canada increased mortgage rates, or increased the overnight lending rate. So, and they did it 2 times, both quarter point. Now, the impact of a interest rate increase on housing, for every quarter of a point increase, we lose 40,000 first-time home buyers in Canada. That's 5% of the market on a quarter point increase. We saw rates go up a half a point. In Canada, that had a pretty significant impact on the market. In GTA, not so. Why? Young, educated, they have money, they can withstand an increase in interest rates better than the profile of the first-time home buyer in the rest of the country. The impact of an interest rate, the interest rate increases in GTA was about 3.5%. Not the same as the rest of Canada. So that's wave number 3. Wave number 4 is about to hit us January 1st. And this is where OSFI, the Office of the Superintendent of Financial Institutions, they govern all of the financial institutions of Canada, how we operate. So on January 1st, they are implementing the mortgage stress test, whereby anybody that applies for a mortgage will have to qualify for the greater of the contract rate plus 2%, or the mortgage qualifying rate, whichever is greater. So right now, you could get a 5-year, maybe a 3.05. January 1st, they have to qualify at 5.05, which would be the greater of, that's that or that rate. So therefore, the borrower has to qualify at 5.05%. Now, we don't quite know the true impact that this is going to have on the market yet. But we do know that this change will impact a home buyer's purchasing power by about 19%. So what that means is that if somebody's buying a home today for $1 million, on January 1st, because of the new qualifications, they could afford a home for $800,000. So it affects their purchasing power by about 19%. And as I say, we don't know the true impact that it's going to have on the market, but we, at CIBC, for the last 3 months, we took our entire mortgage book of business that came in the door, and we took the new stress test and applied it back retroactively to all these customers to see what would happen. Over 90% of the customers that applied to us would pass the stress test. And the 7 or 8% that wouldn't pass the stress test, we would have to think that they don't really deserve to get into housing, because if rates went up, they could not afford the home. And as a result, delinquency and loss, losing their home, would be very, very significant. So, and by the way, we know rates are going up. They're definitely going up. When? I'll talk about that in a minute. So there's the 4 waves. I believe the impact of wave number 4 is about 2%. Just based on what I've seen and based on what the tests that we've run, it's not going to be that significant. Not in GTA. Young, educated, they have money. These guys are going to drive the market. Watch out for prices in 2019. It's going to take off. Because these guys, when they come to Canada, they buy a home 3 to 5 years. Versus the non-immigrant, it's 34 years. Because they're staying at home with mom and dad. These guys are driving the market and will continue to in a big, big way. So your strategy as a realtor is around first-time buyers and new immigrant communities. You're bang on because that's where your business is going to be in the future. Now, you had a question.
What about renewals? How does that affect renewals?
So for renewals, if you renew with your current financial institution, you do not have to go through the stress test. If you, when your mortgage comes up for renewal and you decide to flip to another bank, then you have to qualify for the stress test. So you're stuck with your current bank. Lucky us. And you had a question?
Yeah, you said 2% or 3%. Are we talking price-wise or number of sales? When you said, let's say,
Price,
for example,
total value of sales. Of sales.
going down
In
3%.
numbers or value?
Dollars.
Price, dollars.
Dollars.
Oh, dollar.
And I'll explain that in a few minutes. I'll give you the scenario on the impacts. So, this is where we were, 2016. Now, this is where we are right now. These numbers were just released this week. We had 7,300 MLS sales, down 13% from last year. We're down 19% year over year on a year-to-date basis. Now, if I was the media, I would probably report house sales down 13%, doom and gloom, we're in a crisis, it's still going to crash. But when you get inside the numbers and you say we're down 13%, yeah, we're down 13% from a year that we have never seen before, that was absolutely crazy. So when you go through market stabilization or transition, which we're going through, you would expect to see a decline. This is not bad. This is not bad at all, and I'll explain that too. Average price, $761, we're down 2% versus last year. Not too concerned about prices right now, because when you look at the price, the decline in prices by say property type is detached that are declining more than the multi-unit. New construction, these numbers just came out about an hour ago. We had 4,100, almost 4,200 starts in the month of November in GTA. It's a 45% increase over last year. This is phenomenal. We are headed for the best year in the last 10 years in GTA right now, new construction. 80% of these starts, condo, like multi-unit. In March, it was 30%. There is a huge movement right now towards condo, both in new construction and in resale. Why? Because of affordability. So 80% multi-unit. That's significant.
But where did they get all the land if you're saying that they had problems here before finding the land?
So this is condo. And when we measure new construction, it's based on starts. So if you have a condo development that is 20 or 30 stories and has 3,000 units, that counts as 3,000 starts. So there's several ways of looking at new construction. There's starts, there's completions, and absorptions. And we measure starts because that's what we will expect in the future.
So that's units.
This is units.
Units.
Yeah. We have had the best 3 months in new construction starts in the last 3 months for many, many years. This is very positive. And you're going to see condominium starts like we have never seen before in the next few years. We're going to be around the GO train stations as GO train expands east, west, and north. We're already seeing it. Milton, or not Milton, Burlington was just down there. The huge condo projects right at the base of the GO train. You've got it in Milton. You've got it here at Highway 7 in Wharton. You've got it in Whitby. You've got it up north in Innisfil. They're already starting to build. You will see new construction around those GO train stations that resemble what we saw around Mel Lastman Square when the subway was completed at Yonge and Sheppard. That's what we're going to see at GO train stations in the future. Now, come back to MLS sales. Yes, we had a decline year over year, and it's explainable variance. What's interesting about the MLS activity is that every single month since April of this year, we have seen new listings double, and in some cases triple, the sales. And this is very, very positive and very healthy for housing. We need 12 months of that to get us into a nice, comfortable, stable market. We've already got 8 months where they've doubled or tripled. So 8 months is out of the way, 4 months to go. So here's where we are right now, current state. Now this is how we classify resale markets in any CMA, Census Metropolitan Area. We look at prices, we look at sales volume, sales as a percent of new listings, so this is supply and demand, selling price to list price, and time on market in number of days. So we look at these 5 measurables collectively, not in isolation, and then we determine the state of a market. Then it's either declining buyers, balanced sellers, or overheated. Now for the month of March this year, first time ever, and 1 month only, GTA was in an overheated market. And then, since then, we were in the sellers, and right now, we're moving into balanced market territory. Within GTA, there is one market that is very, very strong, will continue to be strong, stay in sellers market territory, and that's Durham Region, just to the east of us. So what does it mean? Well, balanced market means we will see prices go up, but it will be in line with inflation, say 2.5%. We will see sales volume, MLS sales growing. Sales to new listings, supply and demand will be 35 to 55. Right now we're at 54. Selling price to list price will be in the 90 to 95. Right now we're at 98, but just back to March of this year, I mean, we were at 110, so it's quickly moving over. Time on market will be 55 to 74 days. Right now we're at 29 days, so 28 days. I mean, we were down at 9 days back in March, and it's quickly moving into balance. So right now, 3 of the 5 measurables are in balance. The other 2 are quickly moving in. And that's where we want to stay. This is a healthy situation when we're operating in balanced market territory, because gone are the days where you're going to have situations of multiple offers on one home. You're going to have, you may have a situation, a house gets multiple offers, but not to the degree that we have experienced in the last 2 years. Those days are gone. You'll see offers with conditions now. And that's healthy. And as we get more properties in the market, you're going to see better selection. And the more properties in the market, the more that will contain prices as well. Yes?
So we are moving towards balanced market. We have got 3 already covered and 3 more to go. How long do you think we will stay in the balanced market?
Perhaps for the next year. Yeah. And then watch out, because those newcomers, the new immigrants, that big pool of young, educated newcomers are going to be in a position to buy 2019, 2020, and there's going to be limited demand for that pool of people, and that's going to cause prices to go up. So hopefully we can control it by that time. Now, if I was to take a look at property type instead of a census metropolitan area, right now, detached homes are buyer's territory. That's where they're going to stay. Multi-unit, semi, condo, and townhomes, seller's territory, and that's where they're going to stay. Hence, the two bring us into balance market territory. But detached, it's going to stay in buyer's territory for probably well into the September of next year.
Because of affordability.
Because of affordability and because they increased in prices so much. And the other products right now are much more affordable. Now, when you, just to a thought on that, if you look back in 2007, the price gap between a condo and a detached home in 2007 was $200,000. The price gap between a condo and a detached today is $600,000. Triple. Like, it's just out of reach for a lot of people. And that's why there's slowdown, and that's why there's going to be some further price decline on detached. Put it at less.
But the price per square foot of condos is ridiculous.
It sure is.
And that would count, like that gap is a deal when you look at what the price of a house is.
Now, what you're also going to see, though, on the condo side, right now, 57% of all the condos are one bedroom or one bedroom plus one. But the demand for condos is going to be changing more to family units. And you're going to see developers start to come back to two bedroom and so on. In the 1990s, 60% of all condos were two bedroom plus. Now they're one bedroom and one bedroom plus. So big shift. So that's going to change. Yes.
Terry, I went to a talk by RBC, and what I understood was that new immigrants were not going to be affected by 448. Is there some policy or something that sort of protects them from that? Can you discuss tests or something about employment or something of what you were saying, but they were not going to go to the stress test for the first year or something they were in Canada?
No, it could have something to do with the foreign buyer's tax. If they buy and they end up staying beyond the year, they'll be rebated for the tax that they have to pay. But on the new stress test, it's across the board, everyone. Yeah. So yes. So if they become a permanent resident or they stay beyond the 1 year, they will be rebated that foreign buyer's tax. By the way, on that foreign buyer's tax, I'm going off the tangent here. In the Ontario Fair Housing Plan, the provincial government said foreign buyers this year represented 10% of the market. Well, we did a deep dive. Way back to 2008, foreign buyers represent 2.6% of the market, like less than 3,000 sales last year. It's so small, but yet there was so much about that. And then so the government made the mistake, and then the media takes it and runs with it. Foreign buyers is not a problem. And foreign buyers were buying the high-end properties, like the $1.2 million plus, right? Well, the $1.2 million property value right now is down about 17% since April. The foreign buyer's tax is 15%. So they're going to still buy because it's a wash for them, right? And if they pay, when they pay the tax, if they stay a year and longer, they get the tax back. So they get the benefit of the 15% back, plus the value of the house went down. They got a real good deal. So anyway, got on a tangent there. So let's keep going. So here's what I've done here. I've taken a look at property type. In the 416 the 905, and then the year-over-year change in value, or sorry, not value, sales. So the point here is of all of the sales in the GTA, 70% are condo. In the 905, it's still detached. 60% of the sales are detached. And of the total GTA sales, 60% are in the 905. So it's still very strong. But product of choice in the 416 is the condo. And watch out in the 905 in the future as the GO train expands, you're going to see huge development. And then you've got, what is it? What are we? Okay, Yonge Street. So about 18, 20 kilometers to the east, you've got a new city being built. It's called the city of Seaton. I don't know if you're aware, but right now, today, there's 35,000 new homes being built as we speak.
City of what?
Seaton. It's on Highway 7 and Brock Road. And there's going to be what we know now as an innovation corridor, which is jobs, very, very high-end, high-tech. This is going to be great for the community. And it helps with the supply problem. Because you know, here, I'll just go to the next slide. Here's the average price for a detached in the 416, still $1.2 million. 905, it's down to 890. But if you get inside the GTA, so 416 is $1.2 million. Peel, it's 900,000 for a detached. Halton, it's $1 million. York Region, it's $1.2 million. Durham Region, it's $600,000 for a detached. $300,000 cheaper, 20 kilometers east of here, than anywhere else in the GTA for detached. And that's why Durham Region right now is the fastest growing region in the GTA. Population growth is skyrocketing. 66% of the population growth in Durham Region is new immigrants. The home ownership rate of the new immigrants in Durham Region is 70%. The home ownership rate in GTA for new immigrants is 35%. Durham Region has the highest home ownership rate of new immigrants than any place in Canada. Why? Because of affordability. And that place is just going to take off.
Sure.
Yeah.
The previous slide,
Yeah.
is the data including the pre-construction?
No, this is strictly resale.
Strictly
Yeah. Then you look at the prices by product type. Your condo is still, you know, look, we're $600,000 cheaper, and that's why the demand for the condo. People still want home ownership, and they make their entry point with a condo, and then they move up, and that's just what keeps the market going around. So here's what I've done is I've taken a look by month ever since March when I said we had the numbers, the 1 month only that we've been in overheated state, and then down to today. And I've looked at 3 of the most important measurables that we look at. Sales to new listings, actual sales, and selling price. And what I've done is I've compared them month over month. Now, sales to new listings, which is the correlation between supply and demand, we were at 76% in March. We went down to 72, 67, 63, 60, 59, 56, 54, we're at 52. Every month we've gone down. Now, going down in sales to new listing is positive, because that means what that says is that you've got a good supply for the demand that's in the market. This is positive, so positive. Then you look at sales. March sales over February, 1 month, we went up 51%. Then we dropped 4, we dropped 12, we dropped 22, we dropped 25. Then look at August, sales went up. September, we were flat. October, up 12. November, we're up 4. This is the 5% that the media took from us that's coming back now. And then you look at prices. Prices, we went up 5, then we went flat, down 6, down 8, down 6. August, almost flat, up 6%. September, up 3%. October, November, a glitch, we dropped 2%. This is detached, because all the other 3 property types show an increase. So this is so positive. The market is coming back to us now. And what this doesn't factor in, there's 2 things. One, interest rates. So the Bank of Canada met on the 6th, 2 days ago, and they basically said they're going to hold on interest rates for the time being on the basis of the economic data that's coming in and the potential impact of free trade, the free trade agreement. So they held for December. They'll meet again in January, February, and I believe that they will not increase rates then. And the reason I say that is the economic data that's coming in now and will continue to come in January and February is not going to be as strong as the economic data from the first half of this year, and that's why they increased rates. So I think they're going to hold rates. I don't think you're going to see rate increase till April, May, June. And again, that's dependent on the free trade. Because if it doesn't go through and there's negative, then they may hold off again. But the media, every time the Bank of Canada meets, they start saying interest rates are going up. So when that happens, the people that were on the fence, they jump off the fence and into the market for fear the rates will go up. The other thing is, with the guidelines coming in January 1st, the OSFI guidelines, the stress test, people are starting to jump into the market now. So I think December, you're going to have a very, very strong month. Then come January, February, take a vacation. Because it's going to slow. And then March, it's going to come back. And then we'll have a good balanced market in the spring market. And then a fairly good year next year. Watch out for 2019. As these new immigrants start to get into the market, they're going to create the demand, and the demand is going to cause prices to go up. Watch out for that pool of buyers. So this is very positive, very positive. And it suggests that the worst is over for now. Now, where is the market going this year? We had said somewhere between 89 and 105,000. Right now we're at 89 as of November. We're going to hit probably 92,000 MLS sales this year. Average price 750 to 800. We'll be probably end up at about 770. New construction, we could hit the 44,000 mark. That's very positive. And then new immigrants, 60,000 plus. This is what's going to be the trend for many years to come. And the quality of the people that are coming into Canada is very, very good. Now, to put it into a percentage perspective, of the new immigrants that are coming to Canada, 70% are immediate economic contributors. 26% are family. The balance are refugees. So the quality of the people that are coming here is very, very good. These are educated people, doctors and lawyers and so on. And realtors. So what's the impact of the 4 waves on the market next year? Somewhere between 8 and 15%. I'm saying it's probably going to be total 9%.
Reduction in price, is that, what is that?
Total sales.
Total sales.
Yeah. Price is going to go up. Price will go up 2.5% in line with inflation. You will see some detached struggle with that, but on average, prices will go up 2.5%. Now, to put it all into perspective, in 2016, last year, we did $84 billion in MLS sales in GTA. In 2015, we did $63 billion, $21 billion more. Phenomenal. This was the best year ever. This is the second best year ever. Now, if the market's impacted, I'm saying about 9%. Let's say, for the sake of just round numbers, let's say the market was hit like 20%. Not going to happen. That means that you would take 16.8 billion out. That means this year we will end up $67.2 billion, which is $4 billion better than the second best year ever. This year will be the second best year ever.
What happened?
If the market's affected by 20%, and it isn't going to happen. So, notwithstanding all the negativity from the media and the doom and gloom that you hear from the media, we got the second best year ever. Now, if we put it into a different perspective, if Toronto Maple Leafs have their second best year ever, they'll be in the last game of the Stanley Cup Finals this year. This is good. This is absolutely good. So don't let the media negatively impact your thinking about the housing market in GTA, because it is very, very positive, very strong. Next year, probably have the third best year ever. The year after that, maybe the third best year. It's not doom and gloom. It's actually quite good. And what's even more positive about it, we're going to have the second best year ever this year, third best year ever next year, and you'll be operating in a balanced market situation. Where gone are those 19 offers on one property, where you'll have just a nice, good work environment. That's very positive.
So what would fuel the media and their position? Of course they want to sell the media, but any other financial institution behind that?
No, the media is just negativity, doom and gloom, the worst of everything. And I mean, I'll agree with Donald Trump only on one thing, and that's fake news. It's the negativity. And every time they, hey, listen, I just picked this up. I'll give you a perfect example. The media last night said Toronto home prices down 8.8% since May. The biggest decline in 17 years. Now, how negative is that? When everything that we lost is starting to come back. They're not reporting that. All they report is this crap. So negative. And what does it do? It just causes everybody to panic. And it's not necessary. And that's where the role that you can play is that in talking to your customers, it isn't doom and gloom. It's a perfect time to list. It's a perfect time to buy. Yes?
You mentioned that the government hasn't dealt with the problem which is inventory, right? What do you think they can do? Like, are we talking more land to be available? Or?
So what happened in the Fair Housing Plan is the government said of all the land that we have, we will start to build affordable housing, rental and home ownership. Now that's very positive. But when you start to build a 20-floor building, it takes 3 to 5 years. So we're not going to see this inventory problem fixed until those units are actually lived in. And that's going to take some time. So it doesn't help us now. It will help us 3 to 5 years from now. The domestic investor got out of the market. Why? Because one of the things in the Ontario Fair Housing Plan that was an unintended consequence is that the government imposed caps on the amount of increase that you can increase rent. Well, what investor would want to be buying a home for investment purposes when they can only get a maximum of 2% per year with the risk associated with it, when they can go out in the stock market right now and get 10%? That's why the domestic guys are out of, domestic speculators are out of the market. They'll come back, but it'll probably be late next year and into 2019. Yes?
Where in the GTA are the three branches of government, federal, provincial, and cities? Where are they investing most of their money in reference to developments in the GTA?
They're doing affordable housing projects. And you're going to see right now, of the properties owned by the provincial government, Mr. GTA, 1 in 6 are vacant and they're not being used. And that was reported by the auditor yesterday. And not only is it costing taxpayers, but these are properties that could be converted to affordable housing immediately. So you are going to see a major focus on affordable housing by all 3 levels of government, and it will be managed by CMHC, which is Canada's National Housing Agency. So the $40 billion and the strategy that the federal government has around housing will be for affordable housing, entry-level housing. We have a rental crisis in the GTA right now. There's just nothing available for rent. And renters right now, you know, usually when someone goes to rent a house or apartment, they ask for the first and last month rent. Well, renters now are saying, I'll give you 12 months rent up front. Because that's how desperate they are to get accommodation.
Well, talking about rent, do you do anything, or do you have an idea about the increase in?
Maximum 2% a year.
No, that's the rule.
Yeah.
But, I mean, if you look in this year, last year prices for rent,
Yeah.
they have increased, like for the 1 bedroom, 1+1.
Yeah.
Are they expecting it to keep increasing?
No, there's a cap on it now. There's a cap on it, so they can't increase the level that they were, unless the place is vacant and they have a new tenant, then they can increase it. And when they do that, they will get whatever they ask for, because there's such high demand and low inventory. So those cases where the tenant moves, you're gonna see rentals go skyrocket. You have a question?
Crystal ball question. If I was to advise somebody in terms of an older couple who's thinking about downsizing, I should really say to them, get a home equity line before January 1st under the old rules. Buy your downsized property in February, hold on to your detached home, and sell it in a year.
Or rent it.
Or rent it.
They'll get a huge, great price if they rent it. So rent it temporarily until, say, January 2019. Prices are going to start to take off then. The market's going to come back because of the new immigrants. Prices will start to go up.
And the home equity rules will be under the old rules if they get it in before January 1st.
Yeah. In fact, when it comes to the new rules, the banks are going to start to implement on December 20th. So it means that you have any purchasers out there that are buying in the new year, you make sure you tell them that they have to have a firm approval, no conditions. They have to have a firm approval from the bank. If they don't, they have to qualify for the new rules. Okay, a firm approval. So which means that if they have a pre-approval that was conditional on income verification, make sure they get their income verification in right away. Right away. Now, I'll just wrap up with a couple things on how CIBC can help you grow your business. And these folks out here. Right now at CIBC, any bank for that, we get thousands and thousands of requests all the time for pre-approvals. Through our telephone banking, our branches, through our web. What we have decided to do is that any client that comes in for a pre-approval that does not have a relationship with a realtor, those clients will be referred to our mortgage advisors, who will then hand that client off to a realtor that they have a relationship with. So there's huge potential for you to work with a mortgage advisor, but you're going to get some good leads out of it. The second thing is we have realtor days in the branches. Now, when I talk to a lot of realtors, I say, in this new market environment, how are you marketing? And the most common response is, I'm back to basics. I'm working the phone, I'm doing the door knocking, and so on. Well, to do door knocking in this time of year, it's going to be cold, darn cold. But I can tell you that you can, in partnership with a mortgage advisor, you can go into a branch at CIBC and spend 2 or 3 hours on a given day and talk to clients as they come in and out of the branch to do their banking about housing needs. You will be shocked at the number of leads that you can get. And you'll be talking to hundreds of people. Now, when you think about door knocking, number one, you're dealing with the elements of the weather. Number two, when you're door knocking, the chances of door knocking 100 homes, you might get to talk to 5, if you're lucky. But here you can talk to 100 or 200 in a 2-hour period. It doesn't get better than that. So I really encourage you to talk to our guys about the realtor days. And then I talk about first-time home buyers. We do set up and run first-time home buyer sessions for our clients at the bank. So the clients come in, if they're a first-time buyer, we'll put on a seminar. And our mortgage advisor runs the seminar. And we'll partner with a realtor and a lawyer to come out and talk to these folks. If you have a partnership with these guys, and we're setting up seminars, you have an opportunity to get in front of these people. And we usually get 10 to 15 people out for a first-time homebuyer seminar. The smaller the number, the higher the leads and success rate that you're going to have, because they engage in the conversation. So another opportunity for you is first-time homebuyers. Then we have realtor boards in our branches, where you can display your listings and your profile in our branches. Every single branch has a realtor board. We get 5,000 clients on average through any one of our branches on a monthly basis in GTA. There's no better place to advertise your properties, and you can coordinate it through them. So there's some real opportunities, and I encourage you to talk to them and partner with them and take advantage of those opportunities. So I'm going to stop at that, and thank you very much for. I went way over time, and I'm sorry about that. But yes.
Can you have to the slides to us afterwards?
Yes. Yeah. Now, I think we have a draw for a lockbox. Does everybody have the card in?
Yeah, you're the winner? I think so.
Let's just, Rafaela? Where? Okay, I'm